Let's say you've just inherited 20k. You know you should invest it and you pretty much know what you're going to do, but then you open the news and all everyone's talking about is markets at all-time highs and the potential for a crash. So what do? Do you invest it all in one go, or do you try and split it up in a technique that we call dollar cost averaging? In today's video, I'm going to investigate which one is more effective and which one wins 68% of the time, according to a really crucial study carried out by Vanguard. Hi and welcome back, my name's Zoe, and as a former wealth manager, this is my channel Words on Wealth, where I break down key investing concepts and headlines to make you a more confident investor. So let's start with just breaking down these two key terms. Firstly, it's lump sum investing. The clue's kind of in the name. You get some sort of lump sum, either, as I mentioned, through the example of an inheritance, perhaps you get a redundancy payout, maybe you get a bonus, or maybe you've just built up a big lump of savings that you've never been sure what to do, followed some sort of investing course, and now you're ready to go. That would be an example of a lump sum. And if you just put that straight into investments, you've invested a lump sum. Really, it is as simple as that. The second then is dollar cost averaging, or if you're working off a different currency, you can convert it to that. So it could be pound cost averaging, euro cost averaging, whatever you want to call it. Within dollar cost averaging, as I'll call it for the rest of this video, you split the money up and you invest regularly, perhaps on a monthly basis, to try and ride out some of the ups and downs and the fluctuations within the market. Dollar cost averaging, I seem to see, is absolutely loved, particularly by beginner investors. And the reason for that is because it generally feels safer. It helps to remove some of the guesswork around the market, and it helps to reduce the mental gymnastics that you're playing around, oh, is the market at all-time highs? And what if I do something wrong? And for me, that is the crux behind a lot of those nervous whirrings that take place in beginner and more advanced investors' minds as well, if there is, for example, an emotional attachment to the lump sum of money, that actually they're just really fearing doing something wrong and potentially therefore losing the value of the money that they've put into the markets. Because if you do split it up, what you do of course do is firstly help to remove the chance of you investing the day before a massive crash that we couldn't have foreseen, as with all of them. You help to also reduce, therefore, some of the emotional worries and impact, which could then lead to you withdrawing your money or not investing again, for example, and understanding the logic and rationale behind the markets. It can also help to just smooth out some of the volatility that we see within the markets, particularly over the last year. I think it's fair to say that the roller coaster that we've seen has been relatively unprecedented. And so it's not just about what happens right now in one singular crash, but also what happened last month, what happened the month before, or even the week, 2 days and 3 days before, because the markets are moving really quite a lot in an up-down motion. And if you're putting in average basis once a month, then what you'll see is that some of that volatility might be smoothed out. So here's the argument then to counter that, because what the Vanguard study revealed is that 68% of the time, lump sum investing outperforms dollar cost averaging. It's not super clear cut, don't get me wrong. It's not 99, it's not 98, it's not even 80. But at 68%, this is considerably higher than the 50-50 point. So they carried this survey out with different investors in different time periods in different geographical areas. And when you're comparing the different markets, the figure does change slightly. So within the study, they show that actually it varies between the sort of 62 to 74% mark. It can really vary quite a lot. And that is, of course, because markets can vary quite a lot. If we're comparing just the US stock market between the years of, let's say, 1950 to 1980, then the results would be wildly different to if we're comparing a global market from 1980 to 2026. And if we then compare the last few years where we've had Trump in charge, volatility has been considerably higher as more and more retail investors have got involved with the market, and we've had more and more geographical, geopolitical shocks that have impacted the market since the sort of COVID pandemic in 2020. What we've seen is much greater levels of volatility. And so I really do mean it when I say if we carried out this study, we'd almost need to increase the repetition at which we were carrying out the study by minute, by day, whereas perhaps previously with less volatility, the time gaps could be a little bit further apart because things weren't moving quite as much. If I invest now this morning versus if I invest later today, the results would inevitably be different when comparing that dollar cost averaging to that lump sum investment. So if you're wondering why the reason is that this study shows that dollar cost averaging doesn't beat lump sum investing, it comes down to one really simple theory, and that's kind of the good news behind all of this. It's that actually, over time, markets have historically risen, and so the more time that you can get your money invested in those markets, the better it will be in the long run, because the longer time period it has to benefit from the rule of compounding. If you think of it almost as like a train, if a train is leaving a platform and you've left your money on the platform, every month that it sits on the platform, getting cold, hot, whatever, is another month that it's not sat on that train and moving towards making your money work harder for you. So whilst yes, in some scenarios, you put your money on the train, it moves and it crashes, in the same way that if you put your money in the market and unfortunately it crashes, then actually what we see is that statistically, in the majority of times, putting your money on that train and getting it moving will still be better than not getting it moving at all, which is the risk of that dollar cost averaging. It all comes back to a phrase that is key and I absolutely love, which is that time in the market beats timing the market. Now I'm just going to counter all of this with really a thought on what the key difference and the argument against that lump sum investing could be. Because for sure, if you'd invested the day before the dot-com bubble in the 2000s, the 2008 crash, the day before when the world sank into the COVID pandemic crash, or indeed again in 2022, you'd really wish that you'd probably dollar cost averaged. And if you wished so hard that you dollar cost averaged that you withdrew your money, you'd be in a way worse position than if you'd simply left it in and allowed it to rebound and continue growing. But that's the psychological test. I have this great graph that I've shared before that actually shows the market recovery after the worst days on the market. If for whatever reason you're in the situation, you can always come back to this graph, so just give this video a save. I've also dissected it in much greater detail in another video, which I'll put a link to now, and so that you can watch that. But this graph does go to show what can happen if you remain. But it doesn't go to show, of course, the psychological impact over that purely mathematical factor. If investing gradually keeps your panic low and keeps you invested, then dollar cost averaging for me has got to, in those scenarios, beat that lump sum investing. Whilst it might not be the study-based result, it might not be the mathematically perfect result, it's the one that will still line up with time in the market beats time in the market. So if it were me and I suddenly inherited 50k, let's say, then what I'd probably do is invest the vast majority of it right now in a lump sum. I might leave a little bit behind. Of course, you'd have to assess your own financial situation for things like any immediate payments that were due, whether it's things like debt, whether it's things like building up cash reserves, or whether it's anything that you just want to spend that little bit of money on as well. Then I might, after that, drip feed a tiny little bit into other assets. But if I hadn't inherited any money and I'm just looking at a regular salary, for example, and thinking, oh, okay, well, after what she said, should I be holding back some of my salary and keeping it into a lump sum before then investing it? Absolutely not. Because the reality is that whilst if we've inherited money, we might have a choice between that lump sum and dollar cost averaging, the vast majority of us most of the time will simply be doing dollar cost averaging by virtue of the fact that we get paid in a relatively regular fashion, monthly for example, we'll then be investing monthly and we'll be enjoying that time in the market as and when we can receive the relevant income. So don't hold back money to try and build up a lump, because again, that's going against the key finding of the study, which is that it's all about time in the market rather than timing the market. So there you have a super simple roundup on dollar cost averaging versus lump sum investing. Hopefully that's been helpful. Do make sure you give this video a like and subscribe if you're enjoying it, and I'll see you at the next one.